India constituted nearly a quarter of the world's economy in the year 1700. This was the beating heart of global trade, a land of gold, silk, and spices that sent fine cotton and jewels across continents. Its cities shone bright with craftsmanship and trade. Bengal alone was wealthier than all of Britain, but by 1947, when India finally became independent, its share of the world economy had fallen below 4%. That wealth didn't disappear. It was taken, not only by soldiers, but also by accountants, tax collectors, and trade laws. Welcome to The Financial Historian, where the worlds of money, power, and history collide. And nothing is ever as simple as it seems. For 200 years, the British Empire ran one of the most effective extraction machines in human history. They didn't just rule India, they monetized it. They turned what was once a civilization that had exported luxury goods to Rome, Arabia, and China into a supplier of cheap, raw materials for British factories. And they did it quietly, through numbers, ledgers, and financial design. This isn't a story of nationalism or revenge. It's a story about math, about how one of the richest societies on earth became one of the poorest, not through war, but through accounting. To understand how it happened, we have to go back, long before the Union Jack flew over Delhi. By the early 1600s, India was ruled by the Mughal Empire, a vast, thriving civilization of approximately 150 million people, nearly a quarter of the world's population. Its agriculture flourished, its ports were alive with trade, and Indian textiles were so in demand that European traders risked months at sea just to bring back bolts of cotton. Gold and silver flowed into India, not out. But across the sea, one small island nation was rising, ambitious, organized, and powered by something new, the Joint Stock Company. In 1600, Queen Elizabeth I granted a royal charter to a group of London merchants, the East India Company. It wasn't a government, but it would become one, with shareholders, a board of directors, and soon an army. First, it was just another player in the trade game. Portugal, the Netherlands, and France were there already. While others traded, the British planned to own the trade. Their secret weapon wasn't diplomacy, it was finance. Bond-backed ships, cargo underwritten at Lloyd's, credit lines that traverse London. They didn't just have goods, they had a system. The company soon realized something important. The real profit wasn't in spices or silk, it was in taxes. Then came 1757, the Battle of Plassey, a small fight in Bengal that changed world history. With fewer than 1,000 British soldiers, the East India Company defeated the Nawab of Bengal. But the real victory came later when the company obtained the right to collect Bengal's taxes. It was the birth of corporate colonialism. In years, tens of millions of pounds were drained out of Bengal annually, sparking famine, inflation, and collapse. London boomed while Calcutta starved. Investors in London, people who had never seen India, were getting rich off Indian taxes. The company had become something the world had never seen, a private empire. Even when famine struck in 1770 and 10 million people died, the company's revenues rose. They continued to collect, continued to export grain. It was a good year for London investors. For Bengal, it was hell. And all of it was justified in the name of civilization. British officials claimed they were modernizing India, building railways, schools, and courts. But those improvements weren't built for India. They were built on India. Railways didn't connect Indians to each other. They connected cotton fields to ports. Schools didn't create opportunity, they trained clerks for colonial offices. The courts did not protect justice, they enforced debt. Even the railways, so often praised, were built using British money, under contracts guaranteeing investors a profit of 5% no matter what. If the profits were short, Indian taxpayers made up the difference. The risk was Indian. The reward was British. This was the financial version of a vampire system. It drained without bleeding. Dadabhai Naoroji referred to this as the drain of wealth. Hundreds of millions of pounds were leaving India each year by the late 1800s to fund Britain's Industrial Revolution and its wars. Historians estimate that Britain extracted in today's value $45 trillion from India between 1765 and 1938. It's almost unimaginable, but the consequences were very real. British trade laws destroyed the weavers, artisans, and merchants of India who were once held in iconic regard globally. The British textiles flooded the market and wiped out entire towns known for weaving. Dhaka, once famous for its muslin, was reduced to silence. By the mid-1800s, India had turned from the world's textile hub to just a supplier of cotton to Manchester's mills, and the system kept getting tighter. When droughts came, millions died, even as India kept exporting food. More than 20 million people starved to death while grain shipments to Britain continued between 1876 and 1902. Officials argued that famine relief would spoil the market. Markets had replaced mercy. But perhaps the cruelest trick was financial. India paid for Britain's empire, literally. Indian revenues funded British wars, pensions, and even other colonies. India turned into the empire's bank, its soldiers, its capital, its currency. The Raj's home charges, the annual payments India paid to Britain covered everything from the salaries of officials to the cost of the army. No goods exchanged, no services received, just pure, silent outflow. By the start of the 20th century, these transfers exceeded £100 million a year, billions today. It added up over time to trillions. The pattern is hard to ignore. Britain industrialized while India deindustrialized. Indian towns went dark, while British cities lit up. When independence came in 1947, India inherited not just freedom, but famine, poverty, and a hollowed-out economy. Centuries of extraction had left it, with less than 2% literacy and almost no capital reserves. And yet, when India entered the modern world, it found the same old system, just updated. Global finance had replaced the empire, but the rules were familiar. Developing nations exporting raw goods and importing finished ones, borrowing in foreign currencies, and staying in a debt trap. Sound familiar? Same story, different names, same numbers. Today, it's called structural adjustment, debt dependency, or foreign aid. But the flow of wealth still goes in the same direction, from the poor to the rich. Every year, developing countries send more in interest and profit to wealthy nations than they receive in aid. The empire is gone. The spreadsheets remain. Because what the British built in India wasn't just a colony. It was a prototype of the global economy, a system in which value flows upwards invisibly through credit, trade, and taxes. The Raj was the world's first free market, but only one side was free. And yet, India rose again. It rebuilt itself after 2 centuries of looting, division, and famine through reinvention, not revenge. Today, India is one of the fastest growing economies in the world, but the scars of the past remain. The gap in global wealth still follows the old lines. The routes of empire turned into trade routes, the ledgers of conquest into financial systems. Which leaves us with one question. When a system rewards extraction more than creation, can it ever really be free? Because what the British Empire proved is that empires don't die, they adapt. What India proved is that even the most exploited nations can rise again. But recovery takes time. Extraction is instantaneous. That's the cruel math of empire. The British didn't just conquer India with armies. They conquered it with accountants. And the ledger they opened in 1757, it's still being balanced today. History doesn't repeat. But the balance sheets, they still rhyme. If this gave you a new perspective, hit subscribe. History has the answers, you just have to know where to look.